Good morning, listeners. It's the day we say TGIF, and looks like this week has been worthy enough with the kind of both way swings we have been seeing. It's more or less like a kid stuck in an elevator with equities moving up and down on regular basis. Uh, More than equities, we are also having a good set of economic or the macro data releases wherein the GST collections have surged about 28% to 1.5 lakh crores. Oil prices further correcting, while we are also seeing an increasing expectation on the recessions on the Chinese and the global front. So there is some positive news, there are negative news, but there's one thing which is quite prominent is the dollar's performance against a lot of major currencies, be it euro, GBP, or Japanese yen. If we have to see GBP making a new low altogether, and not just that, we are also seeing bond markets plunging more than 20% from its peaks. This is a new or a first bear market that we have been seeing according to the textbook definitions for this generation. So JK, I'd like your comments on these kind of activities we are seeing over the financial markets.
Yeah, we are definitely in a new era of rising inflation, rising uh, rates, and possibly slowing economy across. In fact, possibly US stands out still because some of the data yesterday that came were strong, including ISM. Then jobless claims were lower, and in fact, Atlanta Fed upgraded the Q3 GDP of USA, from 1.6 to 2.6. But if you look at the other countries like South Korea, Japan, China, all of them had their PMIs being indicated lower. In fact, China actually adds to global growth peers as they have shut down Chengdu, home to some 21 million in a lockdown. And that's the first major lockdown after May. And their PMI has slipped into contraction territory of 49.5. No wonder we had another slump in the commodities, including oil and copper. Then reactions from the market. Of course, before that, I think Eurozone employment was good news from Europe. Gas prices have been still a bit lower, although PMI was slightly weaker than expected. So a mixed bag from Europe, weak from everywhere else, and steady to strong in US. That is the economic picture that we are getting. So in this scenario, the yields in US have been going up across the board. Two-year yield is clearly above 3.5 now. 10-year yield rose about 7 basis to 3.25. And the curve has now definitely flattened to minus 25. It was above 40 sometime, minus 40 sometime back. So the real yields in the US have actually risen. So that's another reason why dollar is getting more traction. Stocks, after slumping more than 6% in the last 5 sessions, made some sort of a recovery, but Nasdaq is still struggling because of higher yields and rates. Also, the NVD and DIA, the company, suffered a big setback after US banned export of chips to AI chips to China. So the uh, rift between China and USA is still simmering on some account or the other. So that's another setback for the Nasdaq index and also the Chinese economy. Dollar index has made a new cycle high or new 20-year high at 109.50, very clearly and well perched there. And the relentless selling of other currencies, particularly the yen and Australian dollar, has continued. Yen because of again widening differential, further widening of differentials, and then Australian dollar and other commodity currencies due to growth concerns. What stands out, of course, euro is still in the range. GBP again slumping to new lows every day, almost targeting 1.14 at least. So the yield difference and the safe haven buying of the dollar has actually really kept greenback in demand. But at the same time, we are observing certain things like Japanese policymakers warned that they were watching currency moves with a high sense of urgency, sorry, and strong language that hints at possible eventual market intervention. Also, the Chinese yuan fixings are a clear signal from Chinese authorities that they're intending to dampen depreciation pressure on the yuan. So these are some indications that the central banks are not happy with the way things are moving in the currency space, but nowadays, compared to the times we are used to earlier, the markets are much larger, and even central banks will have to really calculate their moves even before the intervention, because any failure of intervention will even cause a much bigger slide in the currency. That's what they need to be aware of. Now, all focus is on the unemployment data expected today, and expectation is for a rise of 300K, and the unemployment rate remaining at 3.5%, and hourly earnings at 0.4%. Just that, unlike the last unemployment report, this time market has been positioned for a strong report. Yields are at the peak. Stocks have slumped, given up most of their gains since what happened since June, July, and dollar is at 20-year high. So I don't know if even a strong report is going to cause an immediate rise in the dollar. If that is a sufficient trigger for the next leg of the dollar up move is what I'm wondering. So we might well be seeing a case of profit taking in the dollar, or some position squaring, because we also have a long weekend coming up, because for the US market, because Monday is a Labor Day holiday. So just to indicate to you, after last Labor Day on 6 September 2021, dollar has rallied 20%. So this is just exact 1 year of move, 20% in the dollar index from 91.90 to 110 now. So do we see everything moving in the same direction, whether all good news is not yet priced in, or whether all bad news from others are not yet priced in? This is the thing that when the market returns to full liquidity on Monday, or rather on Tuesday, that's what they will try to assess and make their next move. So interesting week ahead next week, preceded by the jobs report today. And rupee, of course, as per textbook yesterday, it was a move testing the support at 79.25-30 level. It was tested a month back as well. And we saw the hordes of buying coming from importers in the oil companies, and nationalized banks were also heard on the bid. And it was a good opportunity for importers who had been left out and who were panicking just 2 days back at 80 levels, and they were able to get better levels to cover. All said and done, I think the rupee is still placed much better than others. The slowdown in the other regions is really contrasted with much better PMI in India, which is still holding up at very good level at 56 plus. And GDP growth announced day before yesterday, though fell below expectation, it was still very strong. Full year expectation still at a high level. And FI numbers yesterday was negative, but overall tending to be a good trend. So again, important thing, if dollar index breaks up, whether RBI will again protect 80, that's the question on everybody's mind. And possibly, in my view, they would, unless there is a 2 to 3% move up in the dollar index. So we'll have to watch out on the dollar rupee, subject to what is happening in the global markets. Thank you.
Okay, wonderful, JK. And rather, I'd say it's a good question that we are seeing whether RBI will come in and defend the slump in the currency, or whether it will continue to manage its volatility. But folks, I would want to hear from you guys if you have any commentaries, any opinions on these fronts, on the expected actions out of our central bank. While we continue to say that the careful intervention continues to be the key by all the central banks in these kind of markets, and to be surfing above the kind of vicissitudes that we are seeing. On the other hand, folks, USD INR continues to be resilient against the kind of rally that we are seeing in dollar over the past few days. Geopolitical tensions continue to simmer, pushing economies on a concerning side of the macro performance, but there are still positives and negatives constantly being released for each of the economies to perform. So that's that. I will leave you guys with the same question. What do we expect from our central banks to be taking as their actions? Please pour in if you have anything. Till then, we say goodbye and come back next week. Thank you so much for listening.